Hey everybody, some comments today on what is going on. First, let's go over the jobs report. Now, my number, I said there was going to be a very strong jobs report. I was off on the payrolls because I saw the payrolls coming in much higher than the 200K. However, I was absolutely correct on all my market calls. By the way, my analysis now in hindsight was really picking up on the jump in wages and average hourly earnings, and I'll go over that. But my market calls, I said treasuries were going to go down, dollar was going to go up, gold and commodities were going to go down, stocks were going to go down. Absolutely got all of those things, hit the nail right on the head, absolutely 100% correct. The big number in today's jobs report wasn't the 200,000, which was slightly above the consensus forecast and the payrolls. It was the average hourly earnings up 9 cents, and last month was revised up 11 cents, and now the year-over-year gain is now 2.9%. That is the highest or the fastest wage gain since 2009. So the fastest gain in wages in 9 years. That's a good thing. All right. Stock market is down big on that. That's a good thing. Stock market is down on wage growth. You want to see wage growth. That is inflationary. First of all, let me talk about the stock market where, I've been kind of let me call it cautious or negative on it for a while. We've been doing well on individual stocks, but the overall market, which has gone up to 3 averages without a 5% correction in over 25 years, that, and I have said this many times, was a very extreme situation. It was a very stretched situation. I've used the metaphor of a rubber band or elastic band stretched very tight. It's going to snap back. We are seeing the snap back, and I said the other day, and I sent this out in an email to my subscribers, that the bond yields have finally reached a threshold that is presenting headwinds for the stock market. As you know, my MMT trader report, my subscribers know this. You probably know this from the videos I've been putting up. My big macro call now for a while has been short treasuries. I know a lot of the so-called gurus of the bond market, guys like Bill Gross and Jeffrey Gundlach, they just recently said the bond market was in a bear market. They obviously don't understand what drives bond yields and what drives bond prices. It's the monopolist rate setter, which is the Federal Reserve. And I said back in December of 2015, when they reversed course on interest rates, it was time to get out of bonds. And I have basically been short the entire time. We are short the 10-year Treasury future up above 127. You could read that right on my report. And it is now in the 120 handle. So that's 7 big points. That's $7,000 per contract that we have in there. Now, the stock market has been going up and up and up for over a year on a lot of optimism. But now, recently, I would say that the fundamentals are starting to mirror what that optimism, the expectation of that optimism is having now. If you saw it yesterday, and I sent out an email on this, Atlanta Fed predicting a 5.4% growth rate in the first quarter. Now, all that's good news. Higher wages are good news. A very rapid growing economy is good news. However, it's inflationary. Inflationary means it will eat into profits. You can get into a market period much like we had in the 1970s, where the market basically goes nowhere for a long period of time. Is this going to be another crash repeat? And by the way, everybody, you got to just stay very calm. The market goes down. I was on the floor in New York the day, on the floor of the exchange. I'm talking about the day the market dropped 22% in one day. that would be like a 6,000 point drop in the Dow today. If you're getting all crazy and all scared and all bent out of shape and all nervous because of a 260 or 300 point drop, you got to toughen up. The market and investing is not, an investing career is not made in a day. It's not made in a week. It's not made in a month. It's not even made in years. It is made in decades. If you can't handle something like this, if you're getting bent out of shape, if you're freaking out, if you're panicking, if you're scared, if you're depressed, then you got to get out of this activity. You got to get out of this business. You need to toughen up. You need to look at these things either as opportunities or just as a passing squall. All right? This is not going to develop into a 2008, 2009 market collapse. Those were unique situations. Okay? It's where the Fed basically sat on its hands when the whole entire credit structure was freezing up. And it wasn't until Bernanke realized that, hey, I could lend in unlimited quantities against all bank assets because they're already approved and regulated by us, the Fed and the government, as approved bank assets to lend against. He was only lending against the highest collateral, which were treasuries, and it caused a little brush fire, and that's what it is, folks. That's what it was, because the subprime market in 2007, 2008 was a tiny fraction of the mortgage market, and there is no reason in the world why that should have ended up into the conflagration that it was. It was because the Fed abrogated its responsibility. It didn't understand what it was allowed to do. And when Bernanke finally figured that out, I'm allowed to lend in an unlimited fashion against all bank assets because they're assets that the government approves or allows the bank to own. They're regulated and are deemed as good collateral. When he finally did that, the whole thing was all over. And the fiscal stimulus. We got plenty of fiscal stimulus happening. Okay? Don't forget the tax cut impact hasn't even been felt yet. So what is happening here? First of all, you got to keep your heads, people. You got to just relax. I mean, go out, do something else. Don't look at the market or staring at the market. Oh my God, it's down for 5 days. Go out, do something else. But here's the thing. We're in an inflationary period. All right? You got to know how to trade that. If you know how to trade that, if you know how to position yourself in an inflationary period, this is nothing. We make money from this. I make money from this, okay? I don't let 1 day, 2 days, 5 days, 5 weeks, 5 months gyrations affect me, all right? By the way, the dollar's going up. I'm selling the dollar today. All of you people, the dollar's going up. It's inflation. They're going to raise rates. The dollar is going down. I am selling the dollar today, all right? I am buying gold today. We'll see how that plays out. All right. Maybe I'm a little bit early, but I don't want to know something? I don't care. I don't know the exact bottom when the gold turns around. I don't know the exact top of this little pop in the dollar. It doesn't matter to me. I sell the rally in the dollar. I buy the dip in gold. All right. Treasuries are going down. They're going down. And the stock market is in a correction. There will be no crash like 2008, 2009, but this will be a choppy, difficult period where the stock market may give back a good portion of its gains now that it has achieved over the past year. Okay? But the economy is strong, and it is so strong it is generating inflation, and we know the central bankers, how they react to that. My whole thing was not even a bet on the Treasury market. It was a bet on central banker behavior. Everything I said was right. Everything. Now everybody got to calm down. Bye.